I think we're on. Can everyone hear me? Oh, I think I can hear myself. Hello, everyone. Firstly, thank you so much for giving up your lunchtime. I appreciate this is a lunchtime slot. So thank you very much for attending this crypto accounting talk. Your presence here is amazing and equally terrifying. My name, here we go, is Ben Lee. Before I start, a couple of apologies to make. One, apologies for the shorts. I'm going to be hiding behind here, but when I left my sunny home in the southwest this morning, I asked Alexa what the weather was doing in London, and she lied. So that's kind of why I'm dressed for the beach, and when I got to London and it was much colder than I realized it was going to be, I realized I'd made an immediate mistake. Secondly, another apology, because when I give presentations, I usually like to try and put a bit of humor in them. And I'm normally used to talking about tax and data when it comes to crypto. But crypto accounting has probably been my biggest challenge yet, to try and get some humor into this. I've tried, I have no doubt failed you as an audience, but I will try to make this as amusing as it possibly can be. Normally, I would walk around and try and be a bit more enthused and reactive. Sadly, I've got a knee injury, and if I try that, I'm probably going to fall over on my face, but at least there'd be a bit of humor in this presentation. But that's about as much as I can guarantee, I'm afraid. But anyway, a little bit about me. So as I said, my name's Ben Lee. I'm a partner at Andersen. Andersen is a tax advisory and accounting firm. We have a specialized crypto team. We deal with all aspects of crypto tax advisory and accounting. We do international taxation on structuring for corporates. We do the movement of personnel between different countries, of which we're seeing quite a lot of. We also deal with the UK accounting and offshore accounting, as well as tax compliance here in the UK. And I have to backtrack because I forgot there's a little note on this laptop that says, speakers, please make this announcement at the start of your session, which I've already failed. It says, to hear this session more clearly, download the Oliyuse app, if I've said that correctly, to your phone. QR codes are on the back of seats, sidewalls. The password is ACX25, PIN is 2025. Connect your headphones and choose this theater. If you don't want to choose this theater, that's absolutely fine. If you think something more exciting is going on in a different one, I will never know. It's absolutely fine. My plan today is obviously to talk about accounting for crypto, and my plan is to speak for around half an hour, leaving some time at the end for questions. I can talk quite quickly, which my colleagues always attest to, so I will kind of look up from time and time again to see how we're doing. If you're sitting there thinking, oh my God, there's lots of people here, and this is the most boring thing I've ever heard, but there's too many people here to stand up and leave without making a scene, it's fine. Just look at me, shout help at me with those eyes, I'll pick up on it, and I'll try and speed through things as quickly as possible. But anyway, right, why does this matter? Firstly, this matters because crypto assets are not money. If we look at the classic definition of money, it has to perform three functions. It has to be a medium of exchange, a unit of account, and a store of value. And whilst we might have our own opinions on whether cryptocurrency matches that, by those definitions, cryptocurrency isn't money. If it were, we could account for this as money. I probably wouldn't be standing here having this session, and our lives would be much easier. In tax legislation, money is typically legal tender, issued by a sovereign authority, and universally accepted for payments of debts, taxes, and obligations. Now, obviously, even with that definition, cryptocurrency is not money. So why are we here, and why does this matter? Crypto is maturing. The very fact that I'm looking out and there's all these people that are attending this talk shows that we either have an interest in crypto, you just wanted to sit somewhere and have your lunch, or this is becoming more of a thing. If I was giving this presentation 4 years ago, I don't doubt there would have been 3 or 4 people in the audience, and they would likely be my own colleagues. So again, thank you for attending, but I'm taking this as a sign that this is becoming more topical as we go forwards. And a lot of things have changed the landscape. Crypto itself is maturing. It's no longer the assets that degens were investing in 2014 and 2015, or criminals were using on the dark web. It's become an asset where people are looking at putting value into, investing in. We're seeing large institutional investment once again in 2025. The last kind of round we saw of this was in 2022, but this year there's a lot more money going into this space, as well as from family offices. I don't doubt we're all aware how Trump has had an effect on the markets and how that has certainly inflated the price of Bitcoin and various other assets. but it's causing people to look at crypto perhaps slightly more seriously than they were before. And as a result, we're seeing a number of companies who either might be using crypto in their day-to-day activities, because they're either using it for means of payment, or they're receiving it for the services that they've provided, or they might be receiving crypto because they've gone through some funding, they're getting grants, they're working with Web3 companies, and they're receiving crypto as a result of doing that. And that's all great, but it gives us accountants and tax advisors a number of issues when it comes to actually knowing how to deal with these things. So in the course of the next half an hour, what we're going to look at is, what are crypto assets? Sorry if some of you are already aware of that, but actually understanding the different types of tokens within this space is very important in determining how we classify them for accounting purposes. I'm also then going to have a bit of audience participation as we go through, right, okay, how do we actually account for crypto assets? What are they? How do we put them in a set of accounts, and how do we disclose them? And then at the end, sorry, my mother was a teacher, so it's genetic, but we're going to have a bit of a test in terms of where we think some of the examples that I've got lie. And it probably undoes and contradicts everything I've told you before, but let's see what happens when we get there. But, moving forward. Right, types of crypto assets. Out of interest, show of hands already, I'm jumping into the audience participation. Has everyone heard of these terms before? If you have, put your hands up. Awesome, grand, okay. Right, in which case, I will try and go through this speedily. But exchange tokens. What is an exchange token? I've used the word exchange token here. This is very prevalent in HMRC's crypto asset guidance. They define exchange tokens as literally a means of exchange. All that token does is it holds some value, and it's been designed to be used to transfer value from one person to another person. The most obvious example of that is Bitcoin. Bitcoin obviously started back in 2008, 2009, and was developed, and it started this whole new wave of blockchain and crypto assets, but it was designed as a peer-to-peer way of transferring value from one person to another person outside of the traditional financial institutions that we have. And Bitcoin has no other functionality. The core Bitcoin, yes, you've got layer 2s and various other things being built on Bitcoin, but Bitcoin itself, it holds its value, whatever that value may be, but it's just considered a store of value, and it's an exchange token. We also have utility tokens. Now, utility tokens are tokens that, again, you can go online, you can buy these from an exchange, but it's a type of crypto asset that provides access to a specific product or platform. These all exist on blockchains. It's not a crypto asset unless it's on some form of distributed ledger technology, which fundamentally in all these cases is a blockchain. But some of the examples here might be Binance. If you've heard of Binance as an exchange, they release their own token. It's called BNB. You use that on the Binance exchange to effectively pay for trading fees and get a discount. Uni is another token. That is used. Uniswap is a decentralized exchange where you can go online and you can swap tokens. It's no centralized person or company or entity behind it. It's an entirely decentralized exchange where you can swap tokens. And Uni is used as the governance token and fee distribution within the Uniswap network. Link, just another example, is a token that gets paid to node operators who provide off-chain information to smart contracts. I'm already aware there's a lot of terminology in that. Hands up if we're okay with that. Otherwise, I can kind of regress a little bit. Okay, mostly. Right, sorry. Okay, so crypto assets exist in a decentralized world, right? Decentralized means there is no central party that can control it. It is by virtue of the number of people that are partaking in that network. And as a result of that, we are able to exchange things freely between each other. People are able to build platforms that they don't own that allow people to operate in financial ways using these tokens, but without a central party responsible for it. Stablecoins is something you may have heard of. 2025 certainly seems to be the year for stablecoins. And the clue to stablecoins is very much in their name. They're tokens that are designed to maintain a stable value relative to a reference asset. The most common of this is a currency. We call that fiat currency. The big players in this space are the likes of USDC, USDT. PayPal has its own stablecoin called PSUD. And these are all pegged to the US dollar. That means that these entities have, and actually USDC, for example, there is a centralized party called Circle that issues USDC, but they've got collateral, they've got treasury bonds, they've got US dollars, they've got assets so that every token they issue is backed one-to-one from this token to the dollar. That essentially means that, in theory, the token supply should always then match the value of the dollar. Why? Well, this then allows people to transact more freely with US dollars. I can send you USD in moments. I don't have to go through a banking system. We don't even have to KYC each other. I can just send you dollar value very quickly that you can then exchange for actual dollars. The reason that, sorry, this is a side note, but the reason that actually they're getting a lot more interest in 2025 is because obviously if you think of financial institutions and the legacy systems that they are built on, stablecoins, where they are a store of value and can hold their value without being volatile, would obviously, the technology underlying them would expedite a lot of systems that we currently have in the banking world. I'll speed through the last two because they're less relevant, but NFTs, non-fungible tokens, these aren't fungible. A £5 note is fungible. One £5 note equals another £5 note. NFTs are used for provenance and proof of digital ownership, but I don't really talk about them too much in the presentation. And security tokens are exactly that. These are tokens that, on receipt, you have a contractual right to receive profits or equity or some form of value from that token issuance. So, some examples, I'll just pick on one. But let's say T0, it's an equity token which offers dividend rights from their group. So it's like a security. We're seeing more projects actually look at tokenizing real-world assets, tokenizing property, tokenizing shares for this very means. Okay, so what are they? Little Venn diagram of all the things they could be. Are they cash? Are they inventory? Are they an intangible? Or are they a financial instrument? So, let's go through them. Cash or cash equivalent. Right, so cash, these are all the FRS definitions. Cash on hand and demand deposits, or a cash equivalent, short-term, highly liquid investments, readily convertible, insignificant risk and change of value. Hands up if you think cryptocurrencies are cash. Okay, general consensus. There was a little bit of a clue at the start when I said they weren't money, but you're right. For the large part, cryptocurrencies are not cash. Businesses use them like cash, and if you get a client that is doing crypto, that's rubbish, isn't it? Building something in this space, they're working on a project. They might be receiving USD and paying it. There's no doubt they might be using it like cash, but it is not for accounting purposes cash. Okay, moving on. Financial instrument. Financial instrument is a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Hands up if we think crypto is a financial instrument. Okay. I'm hoping at some point I will see a sea of hands suddenly go into the air while everyone's just sitting on the fence, but okay, for a financial instrument to occur, there needs to be two parties. There needs to be one party giving away something, another party getting that something in return for something in the other party, in this case debt, liabilities, equity, etc. As we spoke about earlier on, due to the nature of crypto being decentralized, often there is no third party to owning crypto. If I go onto an exchange, if I walked away from this, I got on my phone, I got on Kraken, I bought some Bitcoin, Kraken is selling me Bitcoin, and I bought some Bitcoin, and it sits there, and that's mine. There's no third party at the other end. If I lose that Bitcoin, there's no third party to go and sue over that. I have no contractual rights. I just have an asset. Okay, moving on. What is it? Is it inventory? Inventories are assets that are held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services. Hands up. Who thinks cryptocurrencies are inventories? Okay. Okay, getting more, a couple of hands up. Okay. They could be. I appreciate we've gone through all of these so far, and I'm like, maybe. Okay, so they might be inventories. Maybe we'll have a look at some use cases afterwards about when a cryptocurrency might fall into inventory. And lastly, intangible assets. Oh, hands going up already. Everyone's jumping on that bandwagon. I haven't got to the question yet and hands are flying in the air. Right, an intangible asset is an identifiable non-monetary asset without physical substance. They're identifiable, so they're separate. Non-monetary, not cash or receivable, but has value, and without physical substance. So I can't throw my Bitcoin at you right now. Okay, hands up, who thinks cryptocurrencies are intangible assets? Oh, you can tell I'm speaking to a room of accountants. That's amazing. Right, yes. For the large part, but not always, cryptocurrencies will be classified as intangible assets. If we break that down, sure, they're identifiable. I've got 1 Bitcoin here, I might have 3 ETH over here. I can sell portions of those, I can sell all of them, but they are separately identifiable from each other. And they can be sold, or transferred, or exchanged. As my prelude gave away, they are not money. There is no right to cash or claim on another party. And they have no physical substance. Probable benefits, it's true. The assets have value. Some assets might be more volatile than others, but ultimately they can be traded for a gain or used operationally. And measurable cost, yes, I can go on an exchange, I can buy these assets. There is a measured cost that will clearly define what I bought that for, so I can measure that in the accounts. But classifying crypto as intangibles brings with it some inherent problems. For those brave enough to put up their hands, this is an audience participation moment, and I'm hoping I can hear you over the general noise of Accountex. What might some of these problems be? Can somebody... Valuation. Right, that's a really, really good one. So whilst we have a market value for crypto, I can go on my phone right now and go, right, these top 10 crypto... I'm trying to walk. Let's hope I don't fall over. Right, I can go on my phone and I can go, right, these top 10 cryptocurrencies are worth X, Y, Z, right? And that will give me a purchase price for those cryptocurrencies. But are these cryptocurrencies worth that? That's an interesting question. So valuation becomes a huge issue. Whilst there might be a list price for these tokens on an exchange, actually what the value of those tokens may be very different depending on the person using those tokens. And there are certain things that we might need to look at for evaluation purposes. If you're looking at intangibles, of course, under FRS, you can revalue with reference to an active market. And just because these tokens are listed and there's market information and pricing available, might not necessarily mean that that is an active market. There may be other reasons why actually you might not be able to dispose of the cryptocurrency you hold. So while something online says Bencoin is worth £10 per coin, sadly there is no Bencoin, but let's say it was worth £10 per coin, maybe there's no real liquidity to that token. Maybe if I wanted to go and sell those, I go to an exchange and I try and sell it, and I can't because there are no buyers for those tokens. And actually, it's very, very thinly traded. There's no liquidity, there's no real value. So whilst it might say that there's £10 per token, if I own 90% of Bencoin, I can't go onto that exchange and sell 90% of the entire token supply because there's no buyer. If there was, it'd probably crash the price because I'm dumping all the tokens onto the exchange. So valuation becomes a huge issue when it comes to actually looking at what these may be worth in the accounts. Thank you very much. Any other problems? Risk? Operation of risk? Yeah, of course. There is, generally, I guess, with businesses holding cryptocurrencies, the element of risk, and obviously we've got directors' obligations, et cetera, safeguarding assets. That becomes a operational risk to a business, for sure. But very specifically to holding them as intangibles. What do we generally need to do? If we're holding an intangible asset on the balance sheet, and we're holding it at cost, what do we need to do into an intangible? Amortize it. And to amortize it, we need to know what the useful life of an asset is. What's the useful life of Bitcoin? Somewhat problematic. FRS doesn't allow us to have an indefinite life for assets. So we're going to have to determine what the useful life of that is and amortize that in our accounts. Bit weird. IFRS does allow for an indefinite life, so you might see some entities actually prefer IFRS over FRS for that very reason. Any other issues? Otherwise, I will tell you them. That's what we're here for. Okay, I'll just show you the rest. Thank you very much, those that participated. So we've done amortization, we've done the issues around revaluation. 3 I've written doesn't quite work. That's probably the least explanatory of all of these bullet points. What I mean by that is we've got something that people are using like cash, but it's not cash. So for accounting purposes, we then need to go, oh, right, but we've received this asset, it's this price, but when you've sold it, it's that price. And typically, when it comes to intangibles, we might be, I mean, it depends on the business type, right? But I would imagine generally, on an annual basis, the number of transactions that we might be looking at putting into an intangible, nominal, might be lower than 100. Maybe 500, 1,000, maybe if you're doing software development, okay, sure, that might ramp up. I've got a client that has built several algorithms, bot traders. They execute 6 transactions per second. They have 200 million transactions in 1 year. And we've got to go and record them in intangibles, potentially. That is very difficult. Arguably, we might not put them in intangibles, but we'll get onto that in a minute. But anyway, the point I'm trying to get at here is we've got something that's been designed to be used as a method of payment that we would typically understand to be cash for the purposes it's probably being used for, but we have to stick it in intangibles most of the time. And as a result of that, we then need data. And it leads us onto our second point, and that data and that tracking point. So yes, because this is all on-chain, because there's lots of reliable data, because anyone can go online and have a look through the entire history of Bitcoin transactions that have ever taken place, but God knows why we would want to, we can get that data. That data is readily available. And there's lots of software that will facilitate this. You can plug in your exchanges, you can plug in various APIs to those exchanges, or CSVs, or custodial wallets, and it will pull all this information in. The only difficulty with that, and this runs into the last bullet point, is at the moment you've got software built for accounting and software built for tax. The tax software is generally very good at bringing everything in and applying the Section 104 pools for corporates or individuals, but it does about 60% of the work. And the reason that it does 60% of the work is because there are a number of transactions happening. If you get this 22-year-old who's building something, chances are he's doing something in one token, but because he loves crypto, you've got about 40 other tokens. You might have 300 different wallets that you're trying to pull in. It all becomes quite complicated, and unless you really understand the nature of what those transactions are doing, then they're not going to be disclosed right in the software, and that might give you the wrong accounting or tax outcome. The other side of it is there's lots of accounting software out there, things like Cryptio, things like Integral, and these do exactly the same thing, but for accounting purposes. The problem that we have here in the UK is they're very much built on a US market. They have options like LIFO and FIFO when it comes to intangible and dealing with that, but they don't do the tax. So they don't apply the Section 104 pooling. So you've got something that's very good for accounts, and you're getting all the right cost data and disposal data. You've then got other software over here that's doing the tax stuff, but when it comes to having this many transactions, if you don't understand the individual transactions and what is happening at that level, it's going to give you the wrong output. I think I've covered both of those points at the bottom. Right, okay. So hopefully that gives you, sadly not solutions, but the things to kind of think about when it comes to the difficulties that you might have to consider and the judgments you might have to take when accounting for crypto assets. So, pop quiz to kind of see us off to the end. A UK limited company has developed some software and has had surplus cash and decides to buy some cryptocurrency to hold as part of its long-term treasury strategy. The last part is irrelevant, but it's stored in a wallet, but it's not intended for sale or operational use. Right, hands up, is this a security token? Is this an NFT? Is this an exchange token? Yeah, right, this is an exchange token. What do we think the accounting treatment's going to be? Intangible, thank you, yes. Cool, exchange token, it's an intangible asset. Second scenario. A UK-based blockchain project has developed its own platform and has issued a utility token called BRL. The tokens have been created and are held in the treasury. They intend to release them over time to incentivize liquidity providers and sell portions to the market to generate revenue. These tokens aren't in circulation and are not being used operationally. Is this an intangible asset? Maybe. What else might it be? Stock. There we go. In this instance, it's its own project's token. They've incurred all of the costs. These tokens may well have a cost basis for recognizing that stock on their balance sheet based on the cost that they've incurred, getting that to TGE. So, arguably, it could be stock. A business invests in tokens issued by a tokenized VC fund. The token contractually entitles the holder to 10% of the fund's annual profits distributed quarterly in fiat. Token type. Is this an exchange? Security token. I want you to come up here. You could do this. Security token, but the accounting treatment. Is it stock? Is it cash? Is it intangible? Maybe. But here, there might be an argument, depending on the contractual basis of the security token, to record it as a financial asset. Maybe. Right, only 2 more scenarios to go. You'll be very pleased to hear. Okay. A UK-based consultancy provides strategic and technical advisory services to a decentralized autonomous organization, a DAO. The DAO pays the consultant monthly in ETH, with the payment agreed at fiat equivalent value at the time of invoicing. If someone receives cryptocurrency, they issue an invoice, they receive cryptocurrency, whatever that cryptocurrency may be, it is always recorded at the value of receipt. So all that's saying is they've received the cryptocurrency, the value when it came in is being recorded. The ETH is received directly into the company's wallet for future use. It's not converted into sterling or used for operational expenses. Token type, exchange token, accounting treatment. It's an intangible. I went back to intangible, sorry. I was going to go through all the different ones, and I thought I'm going to throw something into the mix. But this one, again, would be an intangible. Somebody's performing a service. They happen to be getting paid in crypto. It doesn't form part of their working capital. It's not a trading asset. It's not a trading intangible asset. Sorry, it's not a trading intangible fixed asset. It is simply recorded as an intangible asset. Hang on a minute. Let me just work out what I just said and make sure that was right. Yes. It's not part of their trade, right? Because we have trading intangibles. We also have non-trading intangibles. That's more tax related, but for the purposes of this, we have an intangible asset, right? Last scenario. A company uses USDC, that stablecoin we were talking about earlier, which is pegged to the dollar. It's issued to them and redeemable from Circle, the issuer of USDC. And they use it for settling invoices. It's held in a digital wallet linked to their own account and used for short-term liquidity needs. The token type, I think I've probably given it away. Its answer's already there. It's obviously a stablecoin because it's linked to the US dollar. But what is the accounting treatment here? Could be an intangible asset. Might be a tangible asset. Could be cash equivalent. I don't know why I've written cash or cash equivalent. That's just bad presenting from me. I'm sorry. It should say cash equivalent. And this is something that, when I said stablecoins are kind of flavor of the month for 2025, that people are looking at quite seriously. The issue here being stablecoins hold their value. Where they're fiat-backed, they don't vary in value. They are used as a means of payment. And actually, we start thinking that maybe some of these stablecoins could be a cash equivalent. They're not cash. They're not legal tender. They could be a cash equivalent, but only where there's a third party. Obviously, sterling issued by the Bank of England. This is being issued by Circle. The only reason that this could be a cash equivalent is because I have a contractual ability to redeem this for US dollars from the issuer. If I bought some from Circle, but I actually bought some from another exchange, the stuff I'm buying from an exchange over here doesn't have a contractual right attached to it. I don't have a right to redeem that. So we could end up having one asset, which part of it might be cash equivalent, and part of it might be an intangible. It all gets a little bit silly. Right, okay, developments, just very quickly, kind of where are we in the world? IFRS Interpretations Committee, back in 2019, clarified that cryptocurrencies are not cash or financial instruments. Okay, you've probably heard me bang on about that a lot over the last half an hour, however long I've been talking, although they might be financial instruments, but generally not. have acknowledged need clearer standards on crypto assets. I'm sure you all might agree. In 2023, had a project on cryptocurrencies with a focus on how we go about recognizing and measuring them, how we present and disclose them in the accounts, and determining whether the existing standards are fit for purpose, which I will certainly leave you all to consider yourselves and not put my bias on that. The Financial Accounting Standards Boards in the US actually proposed an update to their accounting rules, which requires them to have them measured at fair value with changes in value reported in net income, but only applies to fungible crypto assets. And this is actually in place now for any US entities with fiscal years starting after the 15th of December. So they're almost a little bit ahead, I think, in changing some of their local accounting standards. Where do we go next? As you may have gathered, as of today, there are no crypto accounting standards specifically under IFRS or UK GAAP. From our conversations today, I say conversations, very much been me talking at you, sorry, but from our conversations, both frameworks struggle with volatility and market pricing reliability. Those are crypto's two main issues when it comes to accounts. Further resources, there is some bits going on in this space. The ICAW, it's a little plug for them, but they had their inaugural digital asset seminar last year held at Chartered Accountants House, where they covered a lot of topics around cryptocurrencies, not only the financial reporting aspects, but also taxation as well as regulation that affects a lot of crypto projects out there. And they do have a financial reporting working group for crypto assets and have started putting out more information online on their website about how we can go about accounting for these. I think I've stuck to time. Thank you all for attending. I've put a cheeky QR code on there. If you wanted to connect on LinkedIn, please do scan. Do so at your peril. I talk about cryptocurrency a lot. If that is something that interests you, then by all means, please let's connect. It'd be great to hear what you're up to, and if I can be of any assistance, then please do let me know. But otherwise, thank you very much for listening to me. We've got about 10 minutes or so now, I think, for questions. If you'd like to catch me at the end and ask me anything in person, then also please do so, but thank you very much. Any questions? There's a question at the front here, sorry. Just so that everyone can hear, if you're happy with the microphone.
Just a generic question. Does it have an FX impact?
Does it have any FX impact? Oh, we see in the account. So I guess it depends.
Of, foreign exchange?
Sure. So where you've got if you had USDC, for example, and you're holding that in your accounts, you might have an FX issue on disposal. But for a lot of this, your biggest issue is that let's say the profit and loss when you dispose of an asset ends up in chargeable gains. Typically, if you're holding it as an intangible asset, because it doesn't fall within the IFA regime, which would mean that profits and losses on the sale of assets fall straight through into the trading comp in a tax return.
It's nothing like an FX gain?
No, so a lot of it would be chargeable gains and losses on the disposal of the assets. But then you need to consider that separately in your tax comp when you're looking at capital gains. That's quite all right. Thank you. Any other questions? No question is too stupid.
Are there any softwares that you'd recommend?
Sure, yeah. The software side of things, there's a few softwares out there, and it will very much depend on what the requirement is. So earlier on I mentioned for accounting purposes, you've got, I highly recommend, and we do use, mainly there's one called Cryptio, there's one called Integral, and there's another one called Bitwave for accounting purposes, but again, largely because there's so much US activity in crypto, and that's largely where the markets are. They've been very much built with that in mind, but they do a very good job for the purpose. They also have links to zero. So where people are getting those sort of daily crypto transactions, whether they're selling something or getting royalties or whatever that might be, they do daily journals into zero. It does require zero to be set up properly, but yeah, they're very good at putting that in. On the tax side, Coinly, you've probably all come across Coinly if you've been involved in crypto assets. I would call it the cheap and cheerful way of getting the data. It's got great chain support, and by that I mean it supports a lot of different layer 1 blockchains, a lot of layer 2 blockchains. From an accounting perspective and a tax perspective, it's very intuitive in the way that you can merge transactions and you can go through and reconcile. Recap is a UK-focused piece of software as well that's very good. Crypto Tax Calculator is an Australian software If you've got individuals that are big on the NFT side, I personally think it handles some of the NFT transactions a little bit better. But those are the main ones that I would probably recommend. Thank you. Any other questions? Oh, no. Oh, it's okay. The microphone's going over there. Unlucky.
So I've got a question about if someone's doing mining, how that comes into it.
Sure.
And how it's treated.
Yeah, sure. So I guess depending on the level of involvement, if it's in a company, but let's for argument's sake that they are trading, the mining rewards that they are then receiving are just going to be taxed as income based on the time when they get those Bitcoin. And obviously if they're trading, the likelihood is that they would be able to, sorry, I've gone into tax mode, but offset the price through capital allowances of all the software and mining rigs and whatever else. For accounting purposes, you're likely going to have fixed assets because you've probably got all of the ASICs? Those are running shoes. What am I trying to say? But all of your boards, your GPUs, everything else that is actively mining the Bitcoin. So you're going to have some hardware as fixed assets. And then when that comes in, I guess it depends what they are then doing with that Bitcoin. The Bitcoin that they're receiving is obviously revenue for the services that they're providing to the network. So of course that's going to be their revenue stream. You've probably got a decision and judgment there as to whether that is going to be held as an intangible asset because it's not their token. It's something that they are using in order to meet the own obligations of the company and satisfy whatever contractual arrangements arise. If they are then actively trading that Bitcoin that they're receiving, you might have an argument that it could be inventory, but I would imagine largely that would fall as an intangible asset, if that answers your question. Thank you. Oh, here we go. I'm saying that because he's my colleague, which makes me terrified about what he's going to ask. 4 minutes left. Make it quick, John.
Hi, Ben. I'll
Hi,
make
John.
it easy for you. I know that you work heavily with the UK government advisory bodies as such, primarily around tax, I think it's fair to say.
Yeah.
It'd just be interesting to know how you feel the UK government's appetite is for legislating around this world, really.
Thank you. Actually, this isn't planned. That's why my eyes have gone upwards to think of the answer. So, back in where were we? 28. No, where were we? I can't remember what the year was now. But anyway, Rishi Sunak came out with this grand plan of the UK being a crypto hub, a global crypto hub. We've got a lot of very talented individuals in the UK that are very keen on crypto, very keen on developing things within the Web3 space. I think it very much speaks to people, this kind of liberal movement of giving power back to the users of the internet. And I think the UK government at that time, because Rishi Sunak was quite tech-focused, understood that. Sadly, nothing really transpired to actually pave the way forward to make these individuals, or crypto in general, what's the word I'm trying to say? It's not easily accessible. We've got the regulation environment as it exists today isn't good for people trying to do things in the space. And that's okay because that's set to protect all the individual people that might go and buy tokens and everything else. But it's forcing a lot of people offshore. And we are continually seeing UK-based tech talent move to the likes of the UAE. In fact, predominantly it is just UAE at the moment because no tax rate. They are really growing a crypto hub over there in terms of the Web3 communities and what they have going on. And dare I say, whilst it is on the government's radar, and there's been recent, publications in the last few weeks around movements on the regulatory side, and as I talked about earlier on, these are largely around stable coins. I do think here in the UK, crypto's got a bad name, and it does for obvious reasons, right? The number of times I'm sure you will have heard of the Wild West of crypto, or you'll see a news headline about energy usage, or another criminal has just done XYZ in tokens, which is amazing. Actually, if a criminal does that, they're incredibly stupid because crypto is the worst thing to commit crime in because it's all traceable. You can trace everything that happens in crypto. So all of these headlines have given it quite a bad appetite. I don't doubt that, if the government was something like, hey guys, let's go make crypto friendly, everyone would be like, cool, but what about all those other problems you're meant to be dealing with? It's not a good look. So it will be interesting post-Trump because he's obviously come along, is trying to seek the US to be, again, competitive on the crypto, in the crypto sphere. And we've certainly seen some project that left the US a few years ago because the SEC would be sending out, a lot of, I forgot what they're called now, but a lot of statement saying, these are security, let's get you in court, etc. So there was a mass exodus from the US, and now actually, all the noise coming out of the US is we're trying to be crypto-friendly again, and people are looking to move back. I saw a headline the other day that Minneapolis, I think, is looking to be the first state to lower the tax burden on crypto. But this is competitive, and this is competitive for people and value. People are changing countries because they can, they're young. Crypto isn't anywhere. They can work anywhere in the world, and countries are jumping on that bandwagon to try and entice them to their country to work there and contribute to their own country's economic activity. We don't have that here in the UK. It's sad that there's a lack of innovation, or those that are very talented and innovative will actively seek to leave the UK because it's just not the right environment for them. And whilst that may benefit us in the longer term, if you look at the likes of the EU, I think I'm going over time, there's hands in the air. I asked you to make it short, and I am continually talking. They've got MiCA, they've got these regulations, they are going first with the regs to try and set them up for success. We're still somewhat left in the dark. And I will stop there because I think I'm out of time. But thank you very much for the question. Cool. Thank you all very much for coming along and listening to me.